It has been a wild month in the stock market, and we're not even halfway into August yet. Monday was the worst day for the stock market since 2022, and yesterday was one of the strongest days for the stock market in all of 2024, and this has a lot of investors confused. Are we really entering a recession like everybody said just a week ago, or is the economy still growing? Is the stock market going to crash, or is the stock market going to go higher? I'm going to break all of that down in this video, and more specifically, I also want to answer three questions. Number one, why is the stock market so emotional right now? What is causing these wild swings? Number two, what did the Federal Reserve Bank say to calm investors down, and maybe I should say to fix the stock market? And number three, how do you find opportunity when you see these wild swings in the stock market? So let me start by talking about what is causing the stock market to see these wild swings in the stock market right now. And let me start by going back 1 week. The initial sell-off in the stock market began because we got a bad piece of manufacturing data, which says that manufacturing in the United States shrank for 4 straight months, and then investors thought that that meant that the economy is shrinking. The next day, we got very bad economic data, which said that employers are hiring less people, they're laying off more people, and wage growth is slowing, which then triggered a bigger sell-off because now people were more concerned about the economy. Then things started to level off. But over the weekend, the Japanese stock market saw its worst day since Black Monday in 1987, which triggered a sell-off across Asian markets, which then got investors in the United States worried, which triggered the big sell-off that we saw on Monday, where the Dow Jones fell by more than 1,000 points. So it was bad news, followed by bad news in Japan, which led to more bad news in the United States. And then things started to calm down. And then just yesterday, we got a good piece of job market data, which says that maybe the job market isn't as bad as some economists thought. And many investors pointed to that as the reason why the stock market really rallied yesterday. But I kind of disagree with that because the data from the job market really didn't say much. It kind of just said that the job market over the last week did as expected. That shouldn't lead to one of the strongest days for the stock market in 2024. There's some more data that I thought was even more interesting, which could be leading to why investors are getting a little bit more confident to dump money into the stock market. And that is, we saw mortgage rates fall over the last week. Now, why did mortgage rates fall? Well, the Federal Reserve Bank didn't cut interest rates, but because of this anticipation of interest rates being cut, we saw more money move into bonds, which pushed bond prices, bond yields lower. As bond yields went lower, mortgage rates were able to come lower too. Essentially what that means that if you wanted to get a mortgage today versus 2 weeks ago, it's a little bit cheaper. But that's still not the biggest part of the story. The bigger part is refinancing also became a little bit cheaper. So what did we see happen? We saw a refinancing boom in applications in just the last week. Now you might wonder, why is that even significant for this? Because the people are now refinancing. Generally, what that means for the average American is you are doing some sort of cash out refinance, especially because home values have gone up. I mean, the last housing market report that we got said that home prices broke a new record high. So if home prices are going up, mortgage rates are going down a little bit. Still, we're not at 4% mortgage rates, but they're down a little bit. If refinancing is going up, people are pulling cash out of their homes. What does that mean? Well, you got to understand, how does our economic system work? Our economic system runs on spending. The more money you spend, the more money somebody else makes. And what we've seen is that for the first time since the pandemic started, Americans are really starting to look for discounts. We saw that maybe in July, where discounting, sales, looking for cheaper options became a big and prominent thing because Americans ran out of money. People maxed out their credit cards, they couldn't keep spending money, and then more businesses and Americans realized we can't keep spending the way that we were before. So if you start to see more cash out refinances, that could mean that more and more Americans have some spending money in their pocket, which gives them the ability to go out, spend more money at Chipotle, buy that extra guac, buy a new car, buy some new clothes, buy the vacation to keep the economy moving. I think that also plays an indication as to something that could keep the economy moving, even though we've been seeing a lot of red flags with inflation and interest rates and the job market. But something you want to pay attention to, something we'll be keeping you posted here and on Market Briefs, our free financial newsletter. And this is why actually next week I'm hosting my live investor summit. It's my biggest investor summit of the year, where I'm going to be going over, number one, how our money has changed over the last 5 decades, but also over the last 5 years. And number two, how you can find new economic trends and opportunities to build wealth in this changing economy during a time where the economy is slowing, during a time where debt levels are very high, during a time where interest rates are also high, during a time where inflation is still bothering people. How do you find economic opportunities? So I'll be going all over this in my workshop. It's completely free. It's live. If you'd like to join, I'm hosting a workshop on the 14th and 15th of August. So if you'd like to join, it's free. Now I got the link for you to join down in the description below. Just make sure you join soon because there's a limited number of people that can actually join me live. Which brings me to number 2, which is what did the Federal Reserve Bank say to calm the markets? In the beginning of this video, I said to maybe fix it. And what I mean by that is on Monday, when we saw this big crash in the stock market, the 1,000 point drop, the Federal Reserve Bank one of the presidents came out and said that if we start to see deterioration in the stock market, that they will, quote, fix it, meaning they might do an emergency rate cut, do some sort of quantitative easing to protect investors. And that gave investors a little bit of reassurance that, hey, if things start to go wrong, the Federal Reserve Bank has got my back. They got my side. Which is a nice feeling because the Federal Reserve Bank has a money printer and they can stimulate the markets, they can stimulate the economy by shoving some more money into it, which can inflate the markets, which also gave investors a little bit of reassurance that, hey, they're watching what's happening in the markets and they also don't want to see things go down too much, especially maybe because it's an election year. Something you want to pay attention to. Now, I do want to make this point here because I want to make sure this is completely clear. Over the last week where we saw this drop in the stock market, it really wasn't that big of a deal. Like when we saw the 2020 pandemic crash, that was a 30+% drop in the S&P 500 in a matter of days. This was a 5% drop in the S&P 500. We have seen many stock market crashes over the last 5 decades. We've seen even more stock market crashes over the last 10 decades, over the last century. It's a part of our system. Corrections, down periods, down days, it's a part of our economy. Now, what we also saw happen, JP Morgan Chase Bank pointed this out. Jamie Dimon, who's the CEO of Chase Bank, made a statement about this earlier this week where he said, during this panic boom or crash, a lot of retail investors were panic selling while institutional investors were buying. What does that mean? Well, in 2020 and 2021, one of the things that happened was we saw this big boom of retail investors entering the stock market, meaning we had a bunch of regular people getting interested in investing in the stock market, and a bunch of regular people started buying stocks in 2020 and 2021 for the first time, which was amazing. The downfall to this is a lot of people are buying stocks and getting into the stock market without much experience, without much education, and without much psychology knowledge of how the stock market works, because the reality is the stock market is emotional, like we saw over the last week. That's nothing new. We have seen many stock market crashes over the last number of decades. And so when we saw this little dip in the stock market, a lot of people panicked. And that panic created the sell-off, which meant that you had a lot of regular people selling stocks, maybe at a loss, or because they were scared. And people that were a little bit more financially savvy, a little bit more financially sophisticated, used it as a buying opportunity. And this ties in nicely to number 3, which is how do you find the opportunity to build wealth? And this is where I want you to understand that markets don't always go up. Look, I'm just a random guy on YouTube. I got to give you this disclaimer. Investing has risks. You are never guaranteed to make money when you invest. In fact, you will lose money at some point, which is why you got to always do your own due diligence and never blindly trust a random guy on YouTube. But investing has risks. What does that mean? Markets go up, markets go down. That is a guaranteed thing. They say nothing is guaranteed in life except death and taxes, but you can add a third one to that, which is that markets go up and they go down. We've been talking about this for many, many, many years. And if you want to be investing in the stock market, that is great, but you have to be able to withstand the ups and the downs. And the reality is, downs in the stock market is where the real wealth is built, because that creates some of the best buying opportunities because everybody else is selling. Now, the interesting thing about that is when you see those down days, people get very emotional and they panic. And it's even more amplified now because of the internet, because when people panic, they start posting it everywhere. They start posting it on Reddit, on YouTube comments, on Discord communities, when you start posting it everywhere about how worried you are in the stock market and how you're panicking. And this is where you, as a financially savvy investor, it is your job to be able to cut through the noise and the emotion. Emotions are the enemy of profits. And this is where I want you to look at history. Look at the history of the stock market. Even if you purchased stocks before the 2020 crash, at the peak of the stock market, before the last major crash, you would still be profitable today if you held on to a stock, assuming that your stock didn't go bankrupt. I mean, if you're investing in the S&P 500, which is the index of the 500 largest companies in the stock market, you would be profitable today. And this is where your investing strategy and your investing psychology is so important. Your investing strategy is, what is it that you're investing in? Are you investing in individual companies, or are you investing in funds like the S&P 500? Now, I can't tell you what to do, and I don't recommend what I do to anybody else, but I'm giving you this example because the S&P 500 is one of the most popular funds to invest in. It's a group of the 500 largest companies in the stock market. Now, if you are investing in that when markets go down, well, now you're just investing in the stock market as markets go down, and as long as markets go up, well, you would make a profit. And this is where now you got to understand, yes, investing has risks. There's no guarantee that markets will go up. But markets went up after the 2020 crash. Markets went up again after the 2008 crash. Markets went up again after the 2000 dot-com bubble bursting. Yes, it was painful. Yes, people panicked. Yes, people sold. Yes, people lost money. But the people that were calm, the people that were financially savvy, the people that understood the financial trends were able to come in, find the opportunity, and scoop up stocks at big discounts. And this is where I want you to understand, number one, the trends, the financial education, and the financial preparedness. The financial preparedness means having cash put aside to protect you, and also cash there to be able to capitalize on investment opportunities. The financial education means understanding how to invest, how to analyze your investments. We're going to be going over this on my live investor summit. And the trends are now, what industries do you want to be investing in? Because obviously you want to invest in a trend where the money is going, not where the money is going out of. And this is where you want to be spending your time researching while things are okay, instead of panicking and freaking out when times are not okay. Because what I can tell you is there are going to be times where things are not okay. There are going to be times where the markets are going down. There are going to be times where we're going to see big crashes. There are going to be times where we see recessions. It's a part of our economy. History doesn't repeat itself, but it does rhyme. We have seen a recession in our economy every decade for the last century. And so what was interesting is we saw this little dip. I mean, 1,000 points is relatively little compared to how much the markets have gone up over the last 5 years. And people panicked. And this is where I want you to understand that we will see bigger crashes, we will see bigger drops, and you want to be able to find the opportunity by staying calm and understanding what's happening in the markets. Now, this is one of the reasons why I've been working so hard to build Market Briefs, which is my free financial newsletter, because the problem that I have with a lot of the traditional financial media is you'll start to see these crazy headlines about markets crashing and all these bad things happening without much education behind it. So it's just saying that the markets are crashing, and it gets people worried that, oh my God, my 401k is going to get sliced in half. My life savings are going to fall. My stock market, my savings are going to fall. And people freak out. That's why within Market Briefs, we break everything down inside of the newsletter, so we don't need all the sensationalism and the story. You just read the newsletter and all the news is there. But what I want you to understand is that media effect exists, and now it's amplified because of the internet, because now you have these communities of everybody talking about how when something bad happens that they sell. I saw it on my own channel, people talking about how they're selling in the comments, and I try to make videos talking about that to stay calm. But I want you to understand that, hey, it's an election year. Markets don't like uncertainty. We have a lot of uncertainty ahead. You want to be a financially savvy investor. Stay calm, because emotions are the enemy of profits, and find the opportunity. Have your strategy in place already. When you see an opportunity, use it as an opportunity to buy and build wealth, assuming you're investing for the long term. I'm not talking to traders. I don't do trading. I don't understand how trading works. Trading is a form of gambling to me. It's a job. That's not investing. Investing is when you want to invest in a good investment for the long term. I'm talking about years or decades. And if that's your plan, what's happening over the course of a few days, a few weeks, a few months, even a couple of years, it's not that big of a deal if you're being a long-term investor and you want to use a downturn as an opportunity to buy, because those create the opportunities to buy good investments at a big discounted price. When Macy's goes on sale, people line up. I don't know if Gucci has sales. I don't know if BMW has sales, but I can bet you if and when they have sales, people will be lined up around the corner. When the stock market goes on sale, people run away. And this is where I want you to stop thinking like the majority of people. Find the opportunity and be a long-term investor. Put on your investor hat or turban and stop being a panic-fueled, emotional trader or an investor.